I want to welcome you all to the third CBER Symposium. We have three great papers. Let me just give you the rules of the game. The presentations are going to be 25 minutes. You can ask questions on the Q&A, but we won't interrupt the speakers for answering questions during those 25 minutes. And after that, there is a 5-minute Q&A where you can also, if there is time, raise your hand and ask questions. Okay, we're going to go to the first paper, which is by Jason Lee and William Mann, Digital Tokens and Platform Building. Jason is going to present the paper. Jason, you're all set. Share the screen.
Yep. You can see the screen?
Yes, yes.
Okay, great. Thank you. Great. Okay, thank you, Kos, for inviting us. So this paper is joined with William Mann, and so it's going to be talking about tokens. So for this audience, I think we don't need to go to too much details about the institutional background of tokens. This is what everybody is interested about. And just to say one thing, that token may come in many different forms. And for example, there are so-called security tokens, which basically represents a security. And the analysis of such tokens are relatively straightforward because these are familiar objects to a finance audience. What is less clear is about those so-called utility tokens. And because they are claimed to serve some operational functions that are distinct from securities. But this claim has aroused some controversy, right? So people are interested in understanding whether there is an economic basis for such an argument, and what explains the appeal of utility tokens to entrepreneurship, and how do they serve a purpose that is distinct from familiar securities or currencies. So in this paper, we'd like to address these questions in a very specific context of platform tokens. Why we're interested in this setting? Because there has been a large class, and probably one of the earliest tokens were issued that are basically trying to back some platform type of business. So they have remained popular since they first appeared. In these so-called platform tokens, an entrepreneur pre-sells a token on a blockchain, which will later serve as a medium of exchange on a peer-to-peer platform. So a very important feature of these platform tokens is that the platform that these tokens are supposed to support will feature what we call a coordination problem, which I'll detail later. And so when this coordination problem arises, potential coordination failures may wind down a otherwise profitable and efficient platform. So we want to argue that, well, by issuing a token, we may actually prevent these coordination failures in platform development. Okay. And so we're going to present a very simple model to illustrate this point. And if we have time, we're going to draw some implications for regulators and practitioners in practice. Okay. All right. So just one example of what we mean by like a platform token. So one example just goes to Filecoin. And this is, by the time it was launched, it was the largest ICO. And a Filecoin essentially tries to decentralize the cloud storage. So instead of like in Dropbox, when we have our files stored at a central server, what Filecoin is trying to do is that everybody can contribute their spare storage spaces and store files on other people's behalf. So when they do so, they will be compensated, and the compensation will take form of an internal medium of exchange, which is also called Filecoin. So and this Filecoin was initially launched during a token sale right before, actually a long time before the platform was first began operation. Actually, the platform just went online a couple of weeks ago, while the token sale happened back in 2017. So if we look at some of those examples of such platforms, like Filecoin or storage, or if we look at, for example, social networks and blockchain infrastructures, a common theme of these platforms is that they require the coordination between users over time. So for example, in the case of decentralized file storage, there are users who want to have their files stored. Also, there are users who are providing their spare storage spaces. So, so there's a coordination problem that happens between these two sides of the market. Right? So especially if there's some cost of participating on this platform, then those who would like to have their files stored would only participate if they expect the other side of the market also joins. So we can immediately see that there could be potential multiple equilibrium, one efficient and one inefficient. And so a token on these platforms is basically just a piece of digital record specifically coded for exclusive use on such platforms. And they are pre-sold before the platform starts operation. And by allowing the services provided on this platform to be paid by those tokens, will show that, well, the token may actually prevent the coordination problem that I just emphasized. So let's just talk about let's build a model to illustrate this this point. This is we think this is probably the simplest model that is rich enough to capture all the ingredients that we have just talked about. We're working on extending the model, but this simple model should give you all the flavor that you need to understand this paper. So time is discrete and runs indefinitely. So there is an entrepreneur who has the capability to launch a platform which allows its users to obtain or provide service from or to each other, beginning from period 1. And we assume there are two potential platform users representing two sides of the market. We call them A and B. So they have alternating demand so that each will demand services and provide a service on a different day. To be specific, so Alice or A will get some service on those odd dates. So on when t is equal to 1, 3, 5, A would like to demand service from the other side of the market. So if she can indeed get a service, she'll get a surplus, which we denote as S. And then on those even days, A can provide a service. And if the service is provided, she will incur a cost C. So B is almost identical to A, except that B just has the exact opposite timing. So on those even days, B can demand a service, and if his demand is fulfilled, he will get a surplus, which is called S. And he can also, on these odd days, he can provide a service at a cost, which we call C. And in addition to the surplus S and the cost C, when a transaction indeed happens, there's also a utility cost, which we denote as U, which is larger than 0, strictly positive, that whenever a user attempts to use the platform, whether attempts to provide a service or attempt to demand a service, that person, that user, will incur a positive utility cost of U. Right? This is going to be incurred regardless of whether the transaction happened or not. Well, you can unilaterally decide on whether you want to incur the cost of U, but then the transaction would only happen when both sides of the market participate. Okay. So, and then we also assume there's a common discount rate, which we call the rho. So just to continue finishing up the model, we assume that the platform is a valuable platform, is an efficient platform. So what we mean is that if you demand a service, and then later on, you first provide a service. That's why when you incur a cost of C and then incur a utility cost of U, and then you later on also demand a service in the next period, the utility that you get is going to be strictly positive. If this condition is violated, then this platform is not creating any value. And so we should not study this platform anymore because they just should not be created at all. Right? So we assume that this condition is satisfied. So in summary, all we have so far is that we provide, we think, is the simplest model to capture. First, there's gains from trade from different users. Also, there's a double coincidence of wants problem, so that the users have to interact with each other dynamically to realize those gains from trade. And also because of this participation cost of U, there is a coordination friction, and coordination failure can potentially happen, especially if you envision that the other side does not participate in the market. You should also choose to not participate in the market and spare this utility cost of U. So in the remainder of the talk, what we're going to do is that because of this double coincidence of wants, we know that the platform has to operate with some medium of exchange. So we're going to make a comparison between using a generic currency as a medium of exchange versus using a platform-specific token. And we will show that by using a platform-specific token, we can effectively exclude this inefficient equilibrium by using an equilibrium selection based on the refinement of so-called forward induction, which we are going to give you more details. Right? So by generic currency, we can just interpret it very generally. It could be either be a US dollar or like fiat currencies, or it can actually just be general use cryptocurrencies such as Bitcoin or Ether. And a platform-specific token will be something that is specifically designed for this particular platform. So it would have no use outside of the platform, and then it will be issued before the platform starts operation. We'll see that both of these two features are going to be important for driving the distinctions between these two types of media of exchange. And then also for tractability, we will always restrict ourselves, the users, to Markov strategies with respect to payoff relevant states. All right, so now let's first look at the platform that uses a generic currency as a medium of exchange. So this diagram basically summarizes the operation of platform that uses a generic currency as a medium of exchange. So on each of the odd dates, there are two users, Alice and Bob, and they can choose to whether to, for Alice's perspective here is that whether, because it's an odd date, so Alice would demand the service. So Alice can choose whether I want to buy the service or not buy the service. While Bob can choose to decide on whether I want to provide the service or not. Right? So anyone who does not provide the service, who does not participate on the platform, is going to incur a stage game utility of 0. Right? So, and if you choose to participate on the platform, but the other side does not choose to participate, then you're going to incur the utility cost of participating on the platform, and then you get nothing else. Only when both of them choose to use the participate on the platform, then the surplus of a trade is going to be realized, and they are going to equally divide the surplus that is being created. Right? So if we, and then whenever this, whenever an even odd date is done, we're going to transition to a even date. On an even date, the payoff is very similar, right? Those who choose not to participate get 0. You choose to participate, but the other side does not show up, you incur the utility cost of participation. And only if both sides participate, then we will have an equal division of the surplus that's being created. Right? So this is how a platform using a generic currency works. Now, what we are going to do next is that now let's introduce a token to a platform, and then we can see how does it change the game that is played among the users. Just to highlight a few points that I have already alluded to before, the token is what the entrepreneur specifies as the medium of exchange on the platform. So the entrepreneur specifies that all trade on the platform must use token. And the token's feature is that it doesn't have any intrinsic value. It is created specifically for the platform. So outside of this platform, it has no intrinsic value. Within the platform, without loss of generality, we can assume that one token would buy you 1 unit of service if the other side shows up. And then before the platform launches, the token needs to be distributed to the users. So, and this is what we will call this an ICO. Well, in practice, it may come in various different names, and we can also call it just a token sale, but just for notation ease, we'll just call this an ICO. And during this ICO, then the token is going to be sold at a price which we denote as P. And an important feature of these tokens is that the token sale is very transparent because it's operated on by typically it's operated by a smart contract that is on an underlying blockchain. So the transparency means that the number of tokens that are issued during this ICO event is observable to everyone. And then once this token sale is done, then the platform will just operate as what we have described earlier. And what we have described earlier is just going to be a sub game after the token sale. We make an assumption about the token price P. So these assumptions have actually very nice interpretations. So on one hand, we assume that the token price P is larger than C plus U. This simply just means that it's more costly to purchase the token during the ICO than trying to acquire the token by providing the service. When you provide the service, right, this is what you're going to incur. So it's more costly to do it in the ICO. And second is that the token price is lower than the maximum amount of lifetime utility that you can get, assuming that the transactions always happen on the platform, right? If the token price is higher than this, then nobody should rationally buy the token because, right, you're gonna pay you would not pay more for you would not pay more than what you can actually get, right? So now with this specification about what a token would look like, now we can look at the game that operates on a platform that uses a token. So first, before the platform actually starts operation, it's at time t0, Alice can choose whether to participate in the ICO, whether to buy the token or not. If she chooses to not buy the token, then ICO fails and the game is over, right? And everybody gets 0, right? So only when Alice buys the token, then the platform will actually start operating. When the platform starts operating, initially it's going to be an odd date in which Alice has the token and Alice want to demand a service. So when that happens, again, those who choose to not participate on the platform will get 0. Those who choose to participate but the other side doesn't show up will incur the utility cost. And if both sides of the transaction participates, then the service demander is going to get a surplus minus the participation cost, and the service provider is going to incur the cost of providing the service and also the participation cost. And if such case does happen, so that meaning both sides they choose to go yes, then the state is going to transit to a even date in which Bob has the token. And then we can see that the utility looks quite similar, except for here is that Alice now is providing the service on an even date, so that if the transaction does happen, she is going to incur the cost of providing the service, and Bob is going to get the surplus. Right? So, and then if that happens, the state is going to transition back to an odd date. So if in any of these two periods, right, if the transaction does not happen, then we're going to just transition to a very uninteresting state. For example, in this state, this is an even state in which that means Alice can actually provide the service and Bob actually want to demand the service. But because no transaction happened in the previous period, so Alice actually has the token. So when Alice has the token, then but she does not want the service. But the Bob wants the service, but Bob does not have the token, so nothing interesting will happen. So the state is just going to transition back. So we can see this basically illustrates how when we introduce a token is going to affect and change the structure of the game. So now we have talked about what our game is. Now we're going to just talk about what our solution concept. This, as alluded before, the solution concept we're going to use is going to be a weakly sequential equilibrium refined by forward induction. So our solution concept is really just like following what Govindan and Wilson in their 2009 Econometrica paper. who formalizes forward induction. So there are two elements into this. So first is weakly and sequential equilibrium. This is very similar to what sequential equilibrium is, except that it relaxes sequential rationality. So it assumes that at any information state, an equilibrium strategies would specify the best response, but this requirement will only happen at those states not excluded by the user's strategy. So this is what the Govinda and Wilson uses to formalize their idea of forward induction. And forward induction, simply put, just means that is a restrictions on people's equilibrium belief. So it simply says that when players are in a dynamic game, at any stage of the game, whatever they observe about the other side is going to reveal something about their future plan. And the requirement is basically assuming that everyone is going to play a rational strategy for the overall game. So if you observe something stupid by your opponent, you know that they are going to do something that eventually will turn out to be rational for the entire game. So that's why we can actually view forward induction as revealing of some of the future action plans. So once we have this solution concept, then we can basically summarize the results coming out of this. So the first result is that on a platform that uses a generic currency, coordination failure could be coordination failure. That means no user participation ever is indeed an equilibrium that satisfies forward induction.
Jason, you have 3 minutes, so plan your time, please. Yeah.
Yes, good. Yeah, I think we're on time. So this is the first result, is that about these generic currency. And then if we use a token as a medium of exchange on the platform, then we'll have the result as that there's going to be a unique equilibrium outcome that satisfies forward induction. And in this unique equilibrium outcome, the Alice purchases the token in the ICO, and the service provision also happens in every period during the platform operation. So just to be clear, is that if we do not impose this forward induction refinement, there could indeed be the other sequential equilibrium outcome, a weakly sequential equilibrium outcome. However, under this forward induction refinement, there's only one unique equilibrium outcome as we have introduced here, which is the efficient one. So just in the remaining time I have, I just want to get this straight, and then we are done. So what the intuition why forward induction selects the efficient equilibrium outcome is, again, based on the notion of forward induction, that any past actions are believed to be rational along with intended future actions. So specific to our setting, like if you are one user and you observe the other side purchase the token already, then you believe that that other person is going to spend it. Why? Because the token is intrinsically worthless. It doesn't have any value outside the platform. If someone purchased the token using real resources and then choose not to use the platform at all, it will not be rational for them to do so. So this is by forward induction, we can infer that any token acquisition in the past indicate a token's expenditure in the future. And also similarly, if I provide a service and accept the token, you will also believe that I will spend it. And finally, if you have ever acquired a token at a high cost, then I believe that in a similar situation in which you can acquire the token at a lower cost, you will do so, because otherwise it would not be rational for you to do that in the past, right? So based on this reasoning, we can actually show that, well, the transactions will always happen on the platform. So we can see that both the token's transparency and the intrinsic uselessness are important for our result. Without transparency, we will not be able to observe the past actions of other users. Without this token being useless outside of the platform, the communication will not be credible. It will not be useful to credibly signal about the future intention to use the platform, right? So the kind of insight coming out of this is that tokens are useful on the platform exactly because they are useless outside of it. Okay, so I'm going to summarize. just to summarize, just showing that we have some robustness results, especially we look at what if like the token could be, the token market could allow speculation. And we show that, well, if this, as long as the speculation benefit from is not too large, then our result is very robust to that. We also actually did a global game setup to make the speculation benefit to be incomplete information. And then we can actually also pin down some probability of successful platform operation. Okay, so I think I'm just going to stop here and leave this implication for practitioners and regulators on the screen, and that's it.
Yeah. Thank you, Jason. Very interesting paper. Let's pause and see if there are some questions. You can put questions in the Q&A, but you can also raise your hand. So let's see. I'm not seeing many questions here.
I see a raised hand.
Okay. Sorry. Let's see.
Hi, this is Jeff. Good to hear from Justin and C. William again. My question was about contrasting. So it sounds like this is this intuition that the token is useful because it's useless. It has this flavor of either signaling or commitment devices. And I was curious. You say that you restrict to Markov strategies, but what if you were to, could you contrast like what's the value of a token in as a commitment device versus something like as compared to something like a repeated game setting where you do like cooperate until like a tit for tat strategy, I guess would be the natural one. Could you contrast sort of the value of the token with like a tit for tat strategy?
Yeah. So William, do you want to take that?
Yeah, actually, this touches on a lot of things that we've had a lot of discussion about. So first of all, it does have a flavor of signaling, but the idea with forward induction is more that your strategy of what you plan to do in the future is something that you can communicate with your actions. It's not quite the same idea as a type. There's a little bit of a subtle distinction, but then within that, it is sort of like the spirit that you know what you plan to do in the future and you signal that to people. What's interesting though is you always have the ability to back out. Like we're not actually, it is not a commitment device in the sense that even after you buy the token, you can choose not to use it. That's not physically prevented, but the other user just doesn't find it plausible that you will actually behave that way. And you can sort of take advantage of that by choosing to buy the token in the first place. So that's kind of how the logic works. Comparing with a tit for tat strategy, to be honest, I have to think a little bit more about the structure of the usual games like that. One thing that's important to notice here is like a lot of models have the sense that in steady state, there is an equilibrium with cooperation, but there's also an equilibrium without. And so what's kind of interesting here compared with a lot of like monetary models, for example, is that we actually completely rule out the bad equilibrium. There's only the good one. But beyond that, I'd have to think a little bit more about the connection with the reputation literature to have a good answer to that. Jocelyn, maybe you have more thoughts on that?
Yeah, so, and also just to add on this, so if we look into literature of forward induction, people actually make a connection between forward induction, which is an equilibrium refinement, with these intuitive criteria in signaling games. So, and the major difference is that in those like static signaling games, the intuitive criteria is a way about people are just signaling about your type, and the type is chosen by the nature, right? And so here in more general in forward induction, here as you can think about we are signaling about, but the signaling is about what my future intention is going to be, and it's not based on what my type. It's based on what I did in the past. Yeah.
Ye, did you have a question?
Yes. So here I just want to probably help Justin and William clarify some other people's concern, which I also had like 2 years ago. So people may say that, well, the token is useful precisely because it's useless outside of the platform. And then some people may say, well, you can sell the token in the secondary market and get dollars. I mean, does this mean that the token is actually useful outside of the platform? But actually the answer is no. I mean, if you sell token to buy dollars, right? This also happens on the platform. I mean, it's a blockchain-based transaction. So basically, I would say that this does not refute the assumption that the token has to be only useful on the platform. Even if it has value in the secondary market, the model still carries through. I just want to clarify this because I had this confusion 2 years ago when I discussed Justin's paper, and now I come around and especially today's presentation.
Thank you. Yeah, I 100% agree with what you said. It's a very subtle point that we've discussed a lot. And to be honest, I wish we could say more formally right now, but we are working on getting this result. If the token acquires some intrinsic value, like truly outside the platform, true value, then that could be a problem for our result. But if people are acquiring the token on the secondary market only for the purpose of using it on the platform, there's no reason to think that which is kind of the distinction you're getting at. But we are working on trying to get some actual results to really show that explicitly in the paper. We don't have it right now, but I 100% agree with, at least I think your interpretation is what we are going to, what we're going to show.
We kind of try to get some endogenous speculation, but it's actually very difficult to do because without additional frictions, actually, we can find that, well, there's not much room for speculation. You have to introduce some additional frictions, which is kind of outside of model. And then just it's a question about what type of additional frictions do you introduce.
Okay, thank you guys. Very nice paper. The next paper is Token-Based Platform Finance by Will Song, Ye Li, and Deng Wang. And Ye is going to present the paper.
Well, first, I want to thank Coase and Fahad for inviting this paper into this very, very special day of tokenomics. So our paper is actually very related to Justin and William's paper in the sense that we also study platform-specific currency. I mean, we differ in the sense that we do not think about a platform-based currency versus fiat currency and whether the platform currency can derive any value at all. We already build on the assumption that the platform has value, it has a platform-specific currency, and you can only use it on the platform, and therefore it has some intrinsic value. So we really follow the tradition of money utility or cash in advance constraint. You can think about it in the macroeconomics way. But the question we are after basically is related to the rise of digital platforms and also the introducing of platform-specific currency that's certainly intended to facilitate user transactions, but at the same time also serving as a way of financing for the platform's continuing development. Actually, if we look at 2018, that was the year that motivated a lot of ICO papers. I mean, the magnitude of financing is almost comparable as venture capital, the token-based financing. And this token offerings not only is about ICO, but also seasoned offerings of the platform that are already launched. But then if we look at 1 year later, 2019, the total volume of token-based financing almost dropped to zero. So this only begs the question that, I mean, what are we talking about, right? So when an entrepreneur says, here I have a platform that facilitates a particular kind of transaction that is going to be very useful for people, and I'm going to introduce a platform-specific currency, what this guy is talking about. So in this paper, we really want to conceptualize a whole token-based ecosystem and that captures basically 3 rows of token. It facilitates transactions among the users. It also finances platforms investment, but at the same time, the founding entrepreneurs, or we call them the platform owners, derive rewards in the form of token-based payouts. So basically,
Professor Lee, I'm sorry to interrupt. Some of your slides are being blocked. Could you try resharing your slides and turn off optimize for a full screen video?
Okay, so let me do this again.
Perfect. Thank you very much.
Okay. Yeah. So let me continue. So what we want to model is basically there's several ingredients, right? So here we want to model the endogenous token demand that is both based on the transaction needs and also speculation or investment. And also at the same time, we want to model the optimal token supply strategy from the perspective of platform owners. Why we want to do this? You may think that in reality, tokens come with a fixed supply, and the fixed supply itself is a particular source of value. If you think about the Bitcoin price in the recent days, right, it just went up tremendously. I mean, the good futures are flat. People say that, well, we are no longer using good as a store of value, but rather using Bitcoin, and the reason is because of fixed supply. But what we observe in reality is that a lot of this blockchain-based platform or digital platforms in general, they do have some form of platform owners, they call it foundations or other names, that actually have some discretion on the token supply. When the token supply will increase or decrease. I mean, in the simplest form, if you think about whoever founded Bitcoin, Ethereum, or some other currencies, they probably reserve a big chunk of tokens to themselves, and the timing of these founders, they releasing these tokens, right? This also affects the token supply. So what we have in mind is that, for the general public, the outstanding tokens really moves over time in a fashion that should optimize the original founder's utility. So this is what we have in mind, and we think this is probably also the paper's contribution, because in this literature, we usually the model starts with a fixed token supply. So the model is like this. I'm going to go very fast later through the formulas and notations, but as long as you get this graph, everything is okay. We have the platform owners, or the platform itself. It decides the token supply, how it varies over time. So you see the token supply increases if you see the platform issues more tokens to gather resources from some contributors. You can think of them as miners, other people who maintain the ledger. Maybe they are the app developers, who make this platform more useful in a sense. And maybe there are some other people like marketing people that try to bring more customer awareness of this platform. So you pay them tokens, right? But then they will sell tokens in the secondary market for consumption goods. And then that this will basically increase the de facto token supply. Another way the token supply can increase is the platforms issue tokens to the owners themselves as a form of payout. That is the reward that I mentioned at the very beginning. And on the flip side of it, we also allow the platform owners to use consumption goods to buy back tokens. And to do that, we impose a financing friction. Basically, when the platform owners go out there and reach financing from VCs or some other investors, see that, okay, it's time for me to burn some tokens out of circulation, buy them back. I need money, okay? And in this process, there will be some frictions, and this will play an important role in the model. And eventually, who are going to be on the demand side of the tokens, right? The users. They use tokens to settle transactions, derive the money utility, and also they speculate. So the question we ask, first of all, if you have any discretion in token supply, where we have any faith in the token value being positive, right? Because the marginal production cost of a digital token is effectively zero. So what imposes discipline upon whoever decides the platform token supply, and what are the implications on inflation and deflation dynamics of the token price. So here we are going to emphasize that if the platform is managing to grow exponentially, there will be some franchise value that plays into the consideration of the platform owners, and this will serve as a discipline. We are going to elaborate on this later. Another question is that here we have a value chain, right? The users demand tokens, and therefore the platform can issue tokens to finance the investment in productivity, that is the quality of the platform, and also reward founders as a result. But what are the pitfalls? What are the inefficiencies in this ecosystem? So we're going to introduce this concept called token overhead, and you will see how the different ingredients come together to give rise to this result. And here we go back to the old literature on macroeconomics, partly due to Nen and I's root in macro. So in macro, right, when we talk about monetary policy, fiscal policy, we talk about dynamic inconsistency. Here you have a platform. This is one agent, playing against a continuum of the users. There is always a concern of dynamic inconsistency. In other words, well, can commitment add value? We know that the blockchain technology through decentralized consensus can really achieve some sort of commitment, and this actually add value. So basically, we think, well, our paper from a modeling perspective, we allow the token supply to evolve over time, serving the interest of some platform owners. But at the same time, precisely by allowing the token supply to be under discretion of the platform owners, we can speak to the value added from blockchain technology through commitment. And that we think is also part of the contribution. Because if you write a model, you started writing a model with a fixed token supply, how can you talk about discretion? How can you talk about token supply being varying over time? And what is the value added from blockchain, by providing commitment, by providing some discipline on the growth of token supply? You cannot talk about this. You can only talk about this if you let the token supply to move around over time and under discretion under self-serving platform owners. So throughout my presentation, I try to draw an analogy between some older literature, for instance, corporate finance, durable goods monopoly, time inconsistency, with our results, and you can see some old wisdom comes out and playing this token-based platform. All right, so the model. I'm going to go fairly fast because it's already 10 minutes. I have only 15 minutes left. So I'm going to spend 5 minutes on the model, and then I just go directly into the results. Okay, so the platform is captured by AT. AT is a stochastic process. I'm going to show you the process later, but right now just take a snapshot of the platform at time t. And the user I, so we have a continuum of users. Each user is different, and the user heterogeneity is drawn from a potentially time-varying distribution of UI. And then if you have a higher UI, you like the tokens better because you derive a higher flow utility, which captures some form of money utility. This really goes back to the transaction value of money. You can think about a Baumol-Tobin model, or even before that, a reduced form to model the fact that if you hold tokens, there will be a probability that you meet some transaction counterparty. And if you use tokens to transact, you will save some transaction costs. And you can think about this convenience yield almost as the expected economic surplus from potential transactions. And here we have the PT, right? The token price in terms of the numeraire consumption goods. So XIT is basically the real balance in utility, right? So that is the value of tokens you hold, KIT units, in terms of the numeraire goods. And we denote NT as the number of users, and we have NT in the flow utility to capture network effect. I said before, right, that the users demand a token for both transaction and speculation purposes. So how do we capture speculation purposes? In equilibrium, the token price will follow a diffusion process. That is the last equation here. The drift and diffusion will both be endogenous in the equilibrium. We are going to solve it. But from the perspective of individual users, they take this process as given and they form their expectation. So that's how they have the investment or speculation motive. And how do we solve the user base? We are going to assume there's a flow participation cost. So only if you have a high enough UI, you will be willing to hold any tokens. And therefore, the user base is basically counting all the people with a UI larger than the threshold, you lower bar T. What determines the threshold? Well, you have the transaction benefits, you have the expected token appreciation, sum them up together. If it's better than the opportunity cost of risk-free rate, then you come in, right? Otherwise, you go out. The break-even guy is the U lower bar T. All right. So the users basically do a static optimization, even if they have a infinite horizon utility function, because they are risk neutral. I'm not going to go into details about this, but once you solve the optimal demand of tokens of individual users, you can do a fairly easy aggregation because demand is linear in heterogeneity. And the demand is increasing in the quality of the platform AT very intuitively because AT drives the transaction of benefits. The demand also increases in the expected token appreciation. This just tells you that if people expect token to appreciate, they will hold more tokens. Once you clear the token market, you basically get a differential equation for the token price. Here we're characterizing a Markov equilibrium with the token supply MT and the platform productivity AT as the two state variables. So basically this one equation, you are going to apply Ito's lemma, and then you say this will give you a partial differential equation for token pricing. So here is what we have went through. This is very similar to our first paper. So now let me talk about how the Markov system evolves over time. We have two state variables, right? What are the laws of motion? So first of all, here is the productivity process. It will grow stochastically depending on the resources that you get. That's the LT. These are the resources that you will pay tokens to get. And then there will be a normal random productivity shock. So we can think about this almost as some inherent characteristics of the platform that is linked to the efforts of the entrepreneurs, founding entrepreneurs, before the platform is even launched. But we are modeling a post-launch platform, so we do not see anything about the entrepreneur's effort. This is short talk, right? I don't have time to go into the literature, but you have many papers that look into the moral hazard of entrepreneurs. This is all pre-launch, so we look at post-launch. This is another way to differentiate our paper from the literature. So once you substitute the normal productivity shock into the process, basically this is the law of motion of the productivity. So if you need LT, you need to pay some tokens, and you divide the price of token, then you get the units of token you actually need to pay out. So here we do not model the optimization of the contributors. We just assume they want a goose equivalent value of F, and then you divide it by PT, and that's how you get the increase of token supply because you want LT. And the token supply will also increase because you may want to pay out dividends to the owners, right? So the dividends paid out within DT, if it's positive, then that will increase the token supply. What about negative dividend? Okay, this is the token burning. When you have the platform owners go out there, buy back tokens from the secondary market, you reduce the token supply. But here you will see there is going to be a financial friction that I'm going to introduce later. So what are the control variables on the part of the platform? It chooses the investment strategy, that is LT. It chooses the payout and the token burning strategy, that is DT. Well, depending on whether you burn token out of the secondary market or you release more tokens through owners payout, the differential of DT can be positive or negative. So the financing cost is modeled in a proportional fashion. So this equation here, or this expression here, is the objective function of the platform. Okay, so it maximizes the token payout to owners, and taking into consideration that if there's a token burning, you actually need to raise some financing to burn the tokens, because you need consumption goods, right, to buy tokens back. All right, so the value function of the platform is also Markovian MT and AT. If there are more tokens circulating, this hurts the value of the platform because this depresses the token price, which in turn imply a lower goose value of the token payout. But if the platform is very productive, the continuation value, the franchise value, the value function is higher. So this is all very intuitive. Here I just write down the law of motion of these two state variables so you know how the platform, how the whole system evolves over time. All right. So this is a whole model. I'm going to just move to the results. It turns out that the ratio of token supply to platform productivity, we can think about this as the productivity adjusted token supply, is really the one-dimensional state variable that drives a lot of actions. So let me just talk about some economics, the key results. Okay, here I want to draw the analogy between durable goods producer and the token supplier. Once you supply token, it will increase the token supply. So it's very much like you produce some durable goods, right? The users will derive some utility from holding that. So the question is, does quotient hypothesis hold in this setting? Basically, if the marginal production cost of token is 0, then the platform may have the incentive to meet the residual demand, right? You capture the guys with the high UI, you want to go down the ladder, capture the guys with the low UI, then you basically allow the token price to decline over time. But the users, they are rational, right? If they expect the token price to decline over time, why they pay the high price to start with, even the high UI guys? So the only equilibrium price is 0. but we are going to break this doom loop. And the reason is that the typical modeling formalization of the quotient hypothesis rely on the stationarity of the demand of these durable goods. Here, the demand of token is actually non-stationary because remember the process of AT, it grows geometrically depending on the platform's investment strategy. That is precisely token finance. And because of this, well, the quotient hypothesis does not hold. So we do have equilibrium with the token price being positive. And here there's another catch. Every time when there are more tokens released into the secondary market, the platform has the concern that if I want to reverse this action, right, I have to pay the financing cost. And here the real option consideration comes into play. So basically, we capture something, that Charles Kyne's 1986 econometrica paper captures. Basically, when you release tokens, you are concerned about this increasing marginal cost, effective marginal cost, because the more tokens you release, the more you will increase the one-dimensional state variable. Remember, M divided by A, and as a result, well, you get closer to burn the token and pay the financing cost. Okay, all this intuition will come back in other results, but here the key idea is that the franchise value, because of exponential growth, serve as a discipline. So we do have positive token price, and the one-dimensional state variable will be bounded up and below by the token payout and burning. So basically, at the upper boundary, that's when the token supply is too much. That's when you burn the tokens. And we are willing to pay the marginal cost of finance because you reduce token supply, you boost the franchise value. That's good for you. Very analogous to luxury goods producers. But at the lower boundary, that's when you feel very comfortable to pay out dividends because relative to the platform's productivity, AT, the supply is not much. So what about the key friction in this system? So when you pay investment with new tokens, it's very likely that AT will increase, right? I mean, there is a random shock, productivity shock, but with a positive mean. So let's say if the productivity increase, this benefits the users. But the question is, can the platform capture all the surplus through investment? The answer is no. Why? Because we have a user heterogeneity and we have one token price that clears the whole token market. So only the marginal guy, remember the U lower bar T, only the marginal guy breaks even. The guys above that, they keep a positive surplus. So here is the interim conclusion, right? So if you make investment, AT increase, the benefit is shared with the users. What about the cost? What if the productivity shock is not in your favor? What if the AT decrease instead of increase? Remember, LT multiplied a normal random shock, and the normal random shock can be a negative value. Your AT decrease, and then you can say the one-dimensional state variable MT, the productivity adjusted token supply, may actually increase. This pushes you closer to the upper boundary, right? That is when you actually pay the financing cost to buy back token. Well, optimally so, because you want to preserve your franchise value, but this cost is borne only by the platform owners. So the upside is shared with the users, the downside is borne by the platform. Well, we have underinvestment, and we need all these 4 ingredients to deliver that. And that is what we call the token overhead. If you have a lot of tokens outstanding, the users are enjoying the benefit of AT being increasing, well, the downside is borne by all by the platform. Well, you have this token overhead. So how to break that? So let me bring blockchain technology. So here there's a standard issue of time.
Yeah, 3 minutes. Yeah, 3 minutes.
Okay. Enough time. So let me give you a story of why the time inconsistency matters here. So now just think, if the platform can commit against the underinvestment, reach the investment ratio at a sufficiently high level, you don't even need to look at the slides. Just hear me, goes to the story. If this is so, right, the users will expect the token's AT to grow, albeit in a stochastic fashion, but drifting up very nicely. And the users will then willing to pay a high price for tokens. This boosts the PT. This will increase the numerical goods value of the token payout that platform owners will receive. So we basically have a virtuous cycle, right? If the platform can commit, the users will expect a faster growth of AT, the users will pay a higher price, the owners will get a higher value through token payout. So what breaks down this virtuous cycle? It is the fact that ex post, Okay, when the platform look at where the MT is, whether it's close to the upper boundary or not, the platform is concerned about token buyback, token burning, the financing cost, and then the platform get timid, invest less, underinvest because of the concern of token overhang, exposed, right? So to break that, you can allow the platform to commit to an investment strategy at time 0. And as a result, the exposed consideration of the platform being timid, refraining from investment, this can be resolved. And eventually the platform owners can actually benefit because the users will pay a higher token price. Okay, so this is the value blockchain can add if you have any discretion in token supply. So we have this numerical example. It's a little bit dramatic. When you have commitment, the value of the platform owners actually tripled. But this is very parameter specific. It's not a quantitative model. It's a qualitative model. So we just want to illustrate the qualitative effect here. So let me conclude. In this model, we try to do several things. But first and foremost, okay, we want to conceptualize a token-based ecosystem to have as many endogenous pieces as possible. And by conceptualizing this whole ecosystem, and then we can answer some economic questions. Because if you restrict the system to be very not reduced form, I would say very contrived, then you cannot answer a lot of questions, right? You want the system to be as realistic as possible, a lot of endogenous actions, and then you can ask questions like, what is the discipline on excessive token supply? And what is the key inefficiency in token-based financing? The dual roles of tokens, right? At the same time, it's means of payment among users, but at the same time, it is also the financing vehicle of the platform. And then we identify this inefficiency that we call the token overhang. And once you have that, you see, well, there's some dynamic inconsistency that comes into play, and maybe that's how the blockchain technology can add value, and maybe that explains why, after the mature of blockchain technology, we see the increasing adoption of platform-specific currencies. I'm down here. Thank you.
Thank you, Ye. Very, very interesting paper. Let's see. Let's look for questions now. Let me see the participants.
Can I ask?
Sure, please.
Yeah. It's so I'm intrigued by the this commitment versus non-commitment. Oh, sorry, that should. I wish you could explain more on the during the process. Is that you're issuing, keep issuing, and then at the boundary you kind of take like repurchase back? Is that kind of the idea?
Yes.
The optimal policy.
Yes. So the optimal
and
policy,
it's a linear problem, right? If it's a linear problem, then it's indifferent. Is that right?
Yes, at the boundary, you are indifferent between buying back tokens or not. But within the boundary, you make the optimal investment decision, issuing token to finance investment. So you can draw the analogy of a Hayashi model with equity issuance cost. That's basically
so you in the investment side, it's not a linear problem. So that's
no. You have an adjustment cost.
I see. Okay. I see. And that and the reason I wanna. Okay, I got it. Thank you.
By the way, you can raise your hand if you have some questions. So use the raise hand feature as well.
So I think it might help if I just share the one slide of model ingredients. I think this may help people to identify potential questions. Sorry, I really went very fast. I know. I hope this is intriguing enough for you to read the paper later.
Yes, exactly. It's a nice paper. A lot of issues which come up in the token-based platforms. Okay, if there are more questions, there'll be some time after all the presentations. Let's now move on to Simon's paper. That's token-based platforms and speculators. Simon adds speculators to some version of the earlier paper. Simon?
Yeah, welcome everybody, and thank you very much for staying here. Today I'm presenting my paper, Token-Based Platforms and Speculators. I would like to start the talk with the following two observations. First, digital platforms that facilitate economic activities and transactions have become increasingly important. Examples of such digital platforms include Amazon, Alibaba, or Ethereum. Second, tokens, or generally cryptocurrencies, have become popular financial assets, with Bitcoin trading around 18K US dollars at the time of this talk. Typically, tokens are intended to serve as a transaction medium, oftentimes on a specific digital platform. This brings us to token-based platforms, which are digital platforms with tokens as the platform transaction medium. In the previous presentations, Jason and Ye have provided excellent arguments for why tokens as platform transaction medium can be useful. In contrast to their papers, I take this feature as given. Instead, I would like to point out that in practice, there are different token investors with different motives to hold tokens. For instance, on the one hand, there are speculators or financial investors who hold tokens to earn investment returns. On the other hand, there are the users of a digital platform who hold the tokens in order to transact on this platform. Naturally, the setting leads to conflicts of interest among the different token holders. For instance, users may prefer a price-stable token to transact, whereas speculators would like to see some price movements or price volatility. In addition, as for any entrepreneurial projects, the development of token-based platforms is subject to agency conflicts between the insiders who develop the platform and the outsiders who contribute capital in exchange for tokens. Motivated by these observations, I ask the following questions in this paper. How do speculators affect moral hazard, platform adoption, and token pricing? And are speculators beneficial or detrimental for token-based platforms? To address these questions, I developed a dynamic model of the development of token-based platforms that features moral hazard as well as speculative investment and transactional investment. In the model, there is a peer-to-peer platform that facilitates transactions among its users. Crucially, tokens serve as the platform transaction medium. As a result, users of the platform must hold tokens to transact on the platform. That is to say, users conduct transactional token investments. In addition, there are speculators or financial investors who hold tokens to earn investment returns. That is, speculators conduct speculative token investments. The platform is developed by an insider, but the insider is subject to moral hazard. For incentive purposes, the insider retains tokens. However, as the insider generally cannot commit to keeping her retained tokens, she sells tokens over time. As a consequence, the insider's incentives deteriorate, moral hazard exacerbates, and the token price decreases over time. That is, the insider's token sales during platform development carry an adverse price impact. Token liquidity or token market liquidity determines the amount of tokens the insider can sell without causing too much price impact. Therefore, token liquidity determines the speed at which the insider sells her retained tokens, which is crucial for the insider's incentives. Also note that token liquidity reflects both the underlying speculative and transactional token investments. Analyzing the model, I obtained the following main findings. First, I studied a link between speculative and transactional token investments. I demonstrated speculative investment crowds out transactional investment. The intuition is that speculators and their investments induce adverse price movements and price fluctuations that discourage users to transact on the platform. In addition, speculative investment is more sensitive to performance in platform development than transaction investment. In particular, speculators who seek investment returns are not willing to buy tokens and do not provide liquidity after poor performance in platform development when expected token returns are low. In contrast, users driven by their transaction needs are willing to buy tokens and provide liquidity even if expected returns are low and platform development has been subject to poor past performance. Next, I look at the relationship between speculators, token liquidity, and the insiders' incentives to develop the platform. I demonstrated speculators affect token liquidity in two opposing ways. First, speculators and their investments increase token liquidity on average, which makes it easier for the insider to sell off her retained tokens and undermines incentives. Second, because speculative investment crowds out transactional investment, and because speculative investment is more performance sensitive than transactional investment, it follows that speculators make overall token investments and token liquidity more performance sensitive. As token liquidity becomes more performance sensitive, it becomes harder for the insider to sell retained tokens after poor performance in platform development, which improves the insider's incentives. As the second effect can dominate, speculators can reduce moral hazard and stimulate the development of token-based platforms. Notably, even though speculators crowd out transaction activities by users, they can have a net positive effect on user welfare. So far, I have looked at a platform that is financed with tokens and that uses tokens as the platform transaction medium. Last, I would like to compare token with equity financing. When the platform is financed with equity, fiat money instead of tokens serves as the platform transaction medium. I show that the use of tokens as platform transaction medium stimulates platform adoption for a reason similar as the ones Ye and Jason have mentioned, but induces more severe moral hazard in platform development. As speculators reduce moral hazard when the platform is financed with tokens, it follows that when this effect is sufficiently strong, token financing is preferred over equity financing. As such, token financing is preferred over equity financing exactly due to the presence of speculators. Let me go into the model. In the model, there are three types of risk-neutral agents. First, there is an insider without transaction needs who discounts at rate R, which is also the interest rate. Second, there is a unit mass of users who apply the same discount rate, but users have transaction needs. Third, there's a mass of speculators without transaction needs who apply a lower discount rate rho. The difference in discount rates may capture that speculators are less financially constrained or less risk averse than users or the insider, which may arise because speculators have less diversified exposure to the platform. I interpret speculators as financial investors, so speculators do not possess any private information or something like that. The platform is developed by the insider, and platform development is completed once a milestone is reached at time tau. The time of the milestone tau arrives at rate lambda times 80, where lambda is a constant and 80 is the insider's unobservable and costly effort. As effort is unobservable and costly, there is moral hazard, whereby the cost parameter kappa indicates the severity of moral hazard. Platform productivity XT, capturing the usefulness, functionality, and transactional benefits of the platform, is initially low and increases once the milestone is reached at time tau. That is to say, XH, the platform productivity after the milestone, is higher than XL, the platform productivity before the milestone. I would like to emphasize that for simplicity, the random arrival of the milestone is the only source of uncertainty in the model. That is to say, the model essentially ends after the milestone is reached, as we will see. Crucially, tokens serve as the platform transaction medium. Tokens are perfectly divisible and in fixed unit supply. They possess equilibrium price PT. As token price is not necessarily stable, there are expected token returns to earn, which is the red term. Users transact on the platform. We model platform transactions as in Kong, Li, and Wang, which is the previous papers. Transacting on the platform is costly for two reasons. First, in order to transact on the platform, users have to hold tokens, which implies a foregone opportunity to invest and earn interest at rate R. That is, users incur the opportunity cost of holding tokens when they transact. The opportunity cost of holding tokens is the interest rate R minus expected token returns. Expected token returns, therefore, reduce the cost of transacting. The intuition is that when tokens serve as the platform transaction medium, users can capitalize on platform success by earning token returns while transacting and holding tokens, which stimulates platform transactions. Second, users incur an entry cost phi the first time they adopt the platform and join the platform. The entry cost phi may be related to the cost of paying attention or the cost of setting up the infrastructure to transact on the platform. Alternatively, phi may also be some switching costs users incur when they switch from another platform to the platform we consider here. The insider develops the platform, but the insider is subject to moral hazard. To possess sufficient incentives, the insider retains tokens, whereby IT denotes the insider's token holdings at time t. The insider maximizes her expected payoff from trading tokens, net the cost of effort she incurs. Let us discuss the speculators. Speculators are risk neutral with discount rate rho, which is also their required rate of return. Speculators maximize the expected profits from trading tokens subject to a short selling constraint. As a result, expected token returns can never exceed speculators' required rate of return. Otherwise, speculators would find it profitable to buy tokens, which would drive up token price and reduce expected token returns. Note that inequality 1 holds inequality when speculators hold tokens, in which case expected token returns compensate speculators exactly for their required rate of return. I would like to emphasize that because there is no more uncertainty after the milestone, there is no more scope for speculative investment either. That is to say, in the model, there can be speculative investment only during platform development before time tau. Speculative investment is denoted by ST. Also observe that ceteris paribus, speculative investment decreases with speculators' required rate of return rho. That is to say, low rho means there might be high speculative investment. I model platform transactions as in the previous paper in Kong, Li, and Wang. That is to say, at any point in time t, there's a number of users on the platform, and this number of users is denoted UT, which is the user base and captures the degree of platform adoption. These users transact on the platform, generating platform transaction volume in dollars NT. I do not derive here how this platform transaction volume emerges in more detail. Observe that platform transaction volume increases with platform productivity XT and with platform adoption UT. Platform transaction volume decreases with the opportunity cost of holding tokens, which is the interest rate R minus expected token returns. The parameter C captures network effects, in that any user's incentives to adopt the platform increase with the number of existing platform users. It follows that speculative investment crowds out transaction investment in the following way. When speculators' required rate of return is low, then expected token returns are low. When expected token returns are low, the opportunity costs of holding tokens are high, which makes transacting on the platform costly and limits platform transaction volume NT. Next, I discuss users' platform adoption decision. Users adopt the platform either at time t equals 0, when the platform is launched, or at time t equals tau, when the platform is readily developed. That is to say, all users act symmetrically and the same. Therefore, platform adoption is either 0 or 1 during platform development. This outcome might seem a bit extreme, but it is merely for analytical tractability. After the platform is developed, there is full adoption. Now note that users adopt the platform initially at time t equals 0 if and only if the benefits of transacting on the platform during platform development are sufficiently large. This is the case when inequality 3 is satisfied. The point I would like to make is that speculators not only reduce platform adoption, but also reduce platform transactions in the following way. A low discount rate of the speculators, so low required returns rho, mean that expected token returns are low, which means again that platform transactions are costly for users, and this limits platform transaction volume. Due to network effects, when platform transactions are costly, it becomes less valuable for any user to adopt the platform. So the presence of speculators essentially discourages users to join the platform. As a result, speculators reduce both platform transactions NT and platform adoption UT. To solve the model, we first characterize the model solution after the milestone, after time tau, and then move backward to the model solution before the milestone. After the milestone is reached, the model solution is very simple as there is no more uncertainty, so the model is stationary. Platform productivity is constant and the platform is fully adopted. So token price is constant too. As the token price is constant, there is no more scope for speculative investment. As in addition, there is no more moral hazard, the insider sees no point anymore in retaining tokens. As a result, the insider sells all of her retained tokens once the platform is readily developed and the milestone is reached. This is important because the prospect of selling tokens at time tau at high price pH motivates the insider during platform development to exert effort. As a result, the insider's token holdings determine the insider's incentives to exert effort during platform development. However, as there are speculators who apply a lower discount rate rho, and as there are users with transaction needs, the insider sees gains from selling tokens. The insider cannot commit to keeping her retained tokens. Thus, the insider cannot resist selling tokens in light of these gains from trade. Therefore, in equilibrium, the insider sells tokens over time. However, as the insider sells tokens, her incentives diminish and the likelihood of reaching the milestone decreases, which implies that the token price decreases too. As a result, the insider's token sales carry an adverse price impact. In light of this price impact, the insider trades in some sense slowly in order to mitigate this price impact. Token liquidity determines the amount of tokens the insider can sell without causing too much price impact. As such, the speed at which the insider sells tokens in equilibrium is pinned down by the prevailing level of token liquidity. Therefore, token liquidity is key for the insider's incentives. The following graph depicts the model dynamics as a function of time before platform development. The insider sells off her retained tokens so that the insider's token holdings decrease over time. As moral hazard exacerbates and the likelihood of reaching the milestone decreases, also the token price, PT, decreases over time. Also observe that the speed at which the insider sells off her retained token decreases, reflecting that token liquidity dries up as moral hazard exacerbates. In the following graph, I plot speculative and transaction investment during platform development as a function of time. While both transactional investment and speculative investment follow a similar pattern and increase first and then decrease, it is notable that there is no more speculative investment when time t is sufficiently large. That is, when the milestone has not been reached for a sufficiently long time. I associate these states with poor past performance in platform development. It follows that speculators who are seeking investment returns are not willing to buy tokens and do not provide liquidity after poor performance in platform development. That is, when the milestone has not been reached for a very long time. In contrast, users driven by their transaction needs are willing to buy tokens and provide liquidity even after poor performance in platform development when expected token returns are low. I conclude that speculative investment is more sensitive to performance in platform development than transactional investment by users. To see why this is the case, it is instructive to look at the insider's token trading in more detail. In equilibrium, the insider's token trading is smooth when the insider's token holdings are sufficiently large and exceed some threshold I star. However, once the insider has sold off her stake largely and the insider's token holdings reach level I star, the insider randomizes between selling no tokens at all and selling all of her retained tokens. When the insider sells all of her retained tokens, she possesses no more incentives to continue platform development and to exert effort. So she terminates platform development. However, the notable thing is now that even if the insider terminates platform development and sells all of her retained tokens, she receives a positive price for the tokens, as users with transaction needs still buy these tokens for a positive price. This illustrates that the presence of users undermines the insider's incentives, as it allows the insider to dump all of her retained tokens at a positive price to users. Token liquidity determines the insider's incentives. I would like to study the link between speculative investment and token liquidity. To assess the impact speculators have on token liquidity, I study the model both without speculators in the solid black line and with speculators, which is the dotted red line. The following graph depicts token liquidity as a function of time t during platform development. Note that when token liquidity is high, it is easy for the insider to sell off retained tokens, which is bad for incentives in the model. As we add speculators to the model, we move from the solid black line to the dotted red line. The right panel is a zoom of the left panel. Now observe that speculators affect token liquidity and therefore incentives in two opposing ways. First, as speculators invest in tokens and provide liquidity early on during platform development, they increase token liquidity at early times, which makes it easy for the insider to initially sell off her tokens and undermines incentives. However, speculators and their investments crowd out platform usage by users. As a result, in the presence of speculators, there are less users on the platform that are willing to buy tokens after poor performance. That is to say, token liquidity becomes more performance sensitive in the presence of speculators. As token liquidity becomes more performance sensitive, it becomes harder for the insider to sell off retained tokens after poor performance, which improves incentives. This can be seen in this graph that when speculators are added to the model, then token liquidity is lower at later times t, which is when the milestone has not been reached for a long time and past performance in platform development has been poor. As this second effect can dominate, speculators can actually have a net positive effect on moral
Simon,
hazard.
3 minutes, yeah?
Yes,
3
thank
minutes.
you. Speculators can reduce moral hazard in platform development and therefore stimulate the development of token-based platforms. In addition, even though speculators crowd out platform usage by users, they can have a net positive effect on user welfare due to the incentive enhancing effect speculators impose. So far, I have studied a platform that was financed with tokens and uses tokens as the platform transaction medium. It is interesting to compare this platform to an equity finance platform. When the platform is financed with equity, we need another transaction medium, which is fiat money then. Platform equity is then simply a claim on platform cash flows that come from transaction fees that are levied to users. Equity is held both by financial investors or speculators and the insider. The moral hazard problem under equity financing and token financing is similar. With equity financing, the insider sells off her retained equity, which undermines the insider's incentives. In this case, stock liquidity determines the speed at which the insider can sell her equity in equilibrium. Now, equity incentives are stronger than token incentives. Put differently, the use of tokens as platform transaction medium and as way of financing the platform induces more severe agency conflicts. The reason is that stock liquidity is only provided by speculators or financial investors. In contrast, token liquidity is provided by users and by speculators. As we have seen, this makes token liquidity little performance sensitive, implying that the insider can cash in and sell tokens even after poor performance. This feature undermines incentives. Now, recall that the presence of speculators can contain moral hazard under token financing. When the incentive enhancing effect of speculators under token financing is sufficiently large, then token financing is preferred over equity financing. In the paper, I demonstrate that this is the case when the following two conditions are satisfied. Notably, condition 5 states that there has to be sufficiently large speculative investment in that speculators' required return has to be sufficiently low for the incentive enhancing effect to be sufficiently strong. I conclude, therefore, that exactly due to the presence of speculators, token financing is preferred to equity financing. If there are no speculators, token financing is subject to so severe agency conflict, which makes it always worse than equity financing. Let me conclude this paper. I studied the conflicts of interest among different token investors, namely speculators and platform users. I demonstrated speculators can alleviate moral hazard in development of token-based platforms. Therefore, speculators can be beneficial for token-based platforms. Token financing is preferred over equity financing exactly due to the presence of speculators. Thank you very much for your attention, and I'm looking forward to receiving your comments and your questions.
Okay, thank you, Simon. Great paper. Any questions? You can also raise your hand. You can go to participants, raise your hand.
I think there is one question from Arash.
Okay, Arash, let me see. Shall I?
Arash,
okay.
I think you're
yes,
unmuted.
I'm going to unmute him. 1 second, Arash.
I think that I'm on mute.
Oh, okay, go ahead.
Okay, I have a question to the third paper. First, thank you very much, Simon. A very interesting paper. My question is that why users should adopt tokens of the token-based platform? Because it seems that it is very costly for them because there is an entrance cost, and also at the beginning time, it is very costly for them to hold the token. And particularly if it is a competitive market where other platforms which are not token-based might offer similar services or products less costly. So I would like to know more about the incentives to enter to a costly token-based platform.
Yeah, so first of all, thank you very much. Indeed, I assume a platform entry cost in which I interpret to be related to the foregone opportunity to join another platform, to transact on another platform. Let's say if you have your data on Filecoin, you would not use Dropbox at the same time, probably. So what comes out in the model is you only join this platform if the benefits of joining the platform exceed this entry cost exceed this entry cost essentially, which is the case which can be interpreted indeed in the light of platform competition, that the platform that is built here is sufficiently better than the other platform.
Thank you.
Okay, great. Okay, any other comments or questions? All right, I want to conclude by thanking all the presenters and everybody who asked questions and everything. So thank you all very much. So remember December 3rd for the next event. Thank you.